transactional market. Now, cost of capital can be assessed from investors' viewpoint or from firm's viewpoint. If we talk about from investors' viewpoint, meaning thereby how much sacrifice made by them, meaning thereby if they have given their money to company, how much money they are expecting in return. The return expected by them is the investor's viewpoint. But if we talk about firm's viewpoint means what the firm has to pay. For example, if company issues debentures worth rupees 10 lakh and the rate of interest is 10%, 10% will came down to 1 lakh. 1 lakh is the cost of debenture. So it is the rate of return which company has to pay the external person, which may be a debenture holder or which may be a shareholder. So that is basically defined as cost of capital. So if you like to define cost of capital, it is defined as minimum rate of return which a fund committed to the project, meaning thereby if we get external fund from debentures or share, we have to pay something that may be 10%, 12%, but we are able to pay only when we are generating. So it is a minimum required rate of return. Minimum means that we have to generate that much minimum. So suppose I have to pay 10% as interest, I have to generate 10%. Now under this minimum rate of return, we are also facing with business risk, we are also facing with financial risk. Business risk already explained in previous units. We have impact of sales on EBIT, that is business risk. Impact of EBIT on your earning per share is financial risk. Am I able to pay interest on time? Financial risk. Am I able to bear out my operating expenses? Business risk. But while calculating cost of capital, premium for both of the risk is included. So if I define my cost of capital, it is much more than minimum rate. So cost of capital is equal to your minimum rate of return plus business risk premium plus financial risk premium. So cost of capital has three basic components. Number one, your risk-less cost, or called as minimum rate of return or minimum cost, plus business risk premium plus financial risk premium. That is your project cost of capital or firm's cost of capital. But firm's cost of capital is not only for debenture, not only for equity. We have number of sources: debenture, equity, preference. So firm is required to compute its overall cost of capital, called as weighted average cost of capital. While we compute WACC, we need to follow certain steps. Step 1, we find out which source we are using, either equity plus debenture plus preference or what else. So first we select the source of fund. Second, we compute their cost, individual cost of debenture or equity. Third, we assign weight to these sources, meaning thereby in the capital structure how much equity, how much debenture and how much preference. We assign weight. Next step, then we multiply the weight with their individual cost. Once we get weighted cost, by multiplying, then weighted cost divided by total weight. So we follow step 1 to step 5. Step 1, we select the source of fund. Step 2, we calculate individual cost. Step 3, we assign weights. Step 4, we multiply cost with weight. Step 5, total weighted cost divided by total weights. We got firm's cost of capital, or called as weighted average cost of capital, or called as your KO. Now, this cost of capital we used in PV assessment. Now, we can also use this cost of capital while comparing with internal rate of return and find out are we profitable or not. We also use this rate of return or cost for assessing worth of investment potential. We also call this rate as cut-off rate, minimum required rate of return. Now, the basic purpose of cost of capital is to maximize your wealth. Why? Because we have to achieve minimum this rate, and this rate will be used in calculating your NPV as well as IRR. Similarly, now under this unit we will get to know how we calculate the cost, how we calculate the book value weights, market value weights, etc. Now, when we talk about the cost has two components. Number one, explicit. Number two, implicit. Explicit means that got opportunity cost. For example, retained earnings. If firm retains some money not given to shareholders, if this money is not given to shareholders, the shareholders are not able to use it. If they are not able to use it, the return which they can generate by using that money would be the opportunity cost of retained earnings. So retained earnings always have opportunity cost or called as implicit cost. So if you look at this diagram, we have always a preference for risk-free securities, then we have government bonds, government securities, then we have corporate bonds, then we have preference, and last is your equity. Equity is highly risky, so it is on the upper front. Now we have risk-free, then we have government, then we have corporate bonds, then we have preference shares, then we have equity shares. Now let's specifically talks about cost of retained earnings. Now, if we talk about cost of retained earnings, it is the opportunity cost of investment. So, if this money is given to shareholders, they can use it and they can generate some return. But not given to them, so they have opportunity. If we want to calculate cost of retained earnings, defined as KR. So KR would be equals to KE. Normally KR is assumed to be equal to cost of equity. Why? Because both is dividend based. So cost of equity into 1 minus TI divided by 1 minus TB into 100. Here TI stands for marginal tax rate. Depends upon individual payment of tax. TB is normally your cost of purchase or brokerage. So we try to calculate cost of retained earning by KE. That is your cost of equity into 1 minus TI tax, 1 minus brokerage into 100. Suppose I say, I want to calculate here KE. Suppose I say my dividend is rupees 2 and price is 20. So KE would be equals to 2 by 20. So if I want to calculate KE, that will be 2 by 20. Let's put in the formula. So KR would be equal to 2 by 20 into 2 by 20 into 1 minus. Suppose tax rate is 60%. So 1 minus 0.6. Suppose I say my brokerage is 2%. So 1 minus 0.02. So 1 minus 0.6 divided by 1 minus 0.02. Multiply by 100. So that's way I need to calculate my cost of retained earning, whereby I got my retained earnings cost equals to 4.1%. So thereby I get to know how do I calculate my cost of retained earning by using KE into 1 minus TI upon 1 minus TB into 100. So that's a way out for assessing cost of retained earning, or called as cost of equity or cost of retained earning. Why? Because retained earning cost is assumed to be equal to equity adjusted for tax, adjusted for brokerage. Let's go for next cost assessment. Now, this is all done. We are calculating WACC at the end. Let's go ahead. We can also calculate cost of debenture. Now, if you want to calculate cost of debenture, debenture can be irredeemable or redeemable. Irredeemable means their money will not be refunded during the lifetime. So we can issue debenture at par, at premium or discount. Suppose 100 rupees debenture issued for 110 premium, 100 rupees debenture issued for 90 discount. So the formula is interest upon P0. P0 here indicates price, how much money you actually receive. Now this price is adjusted for flotation cost, that is your issue expenses, discount or premium. So that will be adjusted price. So numerator is interest divided by receipt of price. Receipt or price means adjusted for tax, adjusted for your brokerage, adjusted for your discount oblique premium. So if I want to calculate the cost of debenture, I will use interest upon P0. If you want to calculate tax also, then interest upon P0 into 1 minus T. Why we multiply with minus T? Because here if we want to calculate tax benefit because interest is always paid prior to tax. So we do interest upon B0 into 1 minus T. But that is for irredeemable debenture. But at present point of time, we doesn't issue irredeemable debentures. Now let's go for redeemable debenture. Now if we want to go for redeemable debenture, that can be again at par, premium or discount. If we use the equation, then we try to equate inflow with outflow. Inflow is B0, outflow is interest plus principal repayment. So I may use equation interest for time period T upon 1 plus KD. KD stands for cost of debenture raised to power T. Summation T tending to 1 to N plus BN. BN means repayment of principal. So BN upon 1 plus KD raised to power N. That's the equation we are going to use. But it's very lengthy process because we have to assume KD. We have to take rates and try to find out does my inflows becomes equals to outflows or not. So we can alternatively use the formula KD. KD is equal to I into 1 minus T plus F flotation cost plus D discount plus PR premium on redemption. We are calculating cost, so we are adding discount plus premium on redemption or repayment because we are paying premium to investor minus PI. Why? Because you receive. So we have F plus D plus PR minus PI. On the whole, we divide by number of years to maturity, NM, number of years to maturity, and this total will be divided by redeemable value means maturity value plus sale value divided by 2. We can use this shortcut formula for computing cost of redeemable debenture. So I into 1 minus T plus F plus D plus PR minus PI upon NM on the whole divide by redeemable value plus sale value divide by 2. Let's see by example. See example, you have 15% debentures of rupees 1 lakh, tax rate 35%. So if I want to calculate at par, your interest is 15,000 and how much you receive? 1 lakh. If 10% discount, you will receive 90,000. So 15 by 90. If at premium 10, you will receive 110. So 15 by 110 and then zeros. So 1 lakh 10,000. Now, but these all three are not for adjusted for tax. So if I want to calculate the tax, then multiply with 1 minus 0.35. Now, this is perpetual means irredeemable. Let's go for redeemable. 15% debentures of rupees 1,000 face value. Redeemable after 10 years. Now time is defined. 5% discount, flotation cost 2.5%, tax 35. Now please understand, discount and flotation cost are normally adjusted on face value. So they are calculated on face value. So your interest is 150. So I into 1 minus T 0.35 plus what's my discount? 2.5% of 1000. So 25. What's about my flotation cost? 2.5% of 1000. So 25. 25 plus 15. Years are 10. How much we are refunding? 1000. And how much we are receiving after discount? 925. Because we are receiving the money after flotation cost and after discount. So 1000 minus 50 minus 25 is my sale value. So 925 plus 1000 divided by 2. I got my value, adjusted value. So that's way I can calculate by using the shortcut. Downside we have the equation, but we are not required to go for equation because here we have to assume cost of debenture and then use interpolation mechanism. But since we have the other method available, so we go by the formula, that is I into 1 minus T plus F plus D plus PR minus PI upon NM divided by redeemable value plus sale value divided by 2. That's your cost of debenture. Let's go for cost of preference share. Again, cost of preference share is almost same as debenture. Why? Because debenture we pay interest, here we pay dividend. So dividend, preference dividend divided by B0. Again, this B0 is adjusted for flotation cost, adjusted for discount or premium. So if 1,000 rupees is a face value for preference share, so what I do? 1,000 minus discount if I have, or if I have premium, so plus premium I try to adjust. So this P0 is adjusted for premium, discount, flotation cost. Now upper one numerator is PDIV, preference dividend, but this dividend is always with tax. So PDVI into 1 plus DT. Written downside, PDIV can be taken as PDIV into 1 plus DT, that is preference dividend into 1 plus taxes. Now this is for irredeemable debenture. If I want to calculate for redeemable debenture, I may use the equation that is P0 or NP, net price. How much you receive is equal to how much you pay. So left hand side is receipt, right hand side is payment. So preference dividend upon 1 plus your KP, cost of preference share raised to power T for time, because you are paying dividend from year 1 to.
Boss, how are you, boss? Good, boss. Boss, I want to go out. When the drivers plan to go at 4. There is place or no? Drive. Even Ahmed. Ahmed or
Ahmed.
Ahmed. Give me his number, please.
No, Rebor.
Reward. Give me his number. Maybe I have it in here. Too. I
0750
0750
470
470
1244
1
244.
244. Okay, thank you. Good. Could you please check my balance? Ramiz make me crazy. Yeah. He told me that he could recover the days which I spent in Tunisia, but when I check the balance, nothing.
I did not count it since then. So Saturday, we'll count it. Saturday.
Saturday, you can confirm with the Shams it's counted or no?
Yes, Sunday we can confirm.
Okay, good. Okay, go, boss. Thank you.
No problem.
To N plus Pn, because you are refunding the principal. So Pn upon 1 plus Kp raised to power n. But again, it is a formula, so we can go by a shortcut formula. The shortcut formula which we done for preference share, sorry, debenture. So if I want to calculate Kp would be equal to D into 1 plus dt. Similarly, because in debenture we have I, so where we have D, but interest is paid prior to tax, so 1 minus T. But here dividends is with tax, so 1 plus dt plus F plus D plus PR minus PI upon NM, and the whole divide by redeemable value plus sale value divide by 2. The formula, that's the same formula which we have used for cost of debenture, but here the only change is that we are using D into 1 plus dt. This is a formula for cost of preference shares. So if you want to assess the cost of preference, we use Kp is equal to D into 1 plus dt plus F plus D plus PR minus PI bracket close in divide by NM, that is number of years to maturity. Then on the whole divide by redeemable value plus sale value divide by 2. That's way we can calculate cost of preference share for redeemable. Normally for debenture as well as preference, we used to calculate redeemable only, because at present point of time companies are going only for redeemable preference share or redeemable debentures. So now for this unit we have already covered cost of retained earning, cost of debenture, cost of preference shares. Let's go for cost of equity. Very, very important. Why? Because under equity capital, the cost computation is only a dividend forecasting, dividend expectation. So under this, there is calculation which depends upon only expectation. So either I assume there is no growth in dividend, or I assume there is a normal growth in dividend. If there is a zero growth, I will use the formula dividend upon P0, or dividend upon current market price. So D upon P0 or D upon CMP, current market price. But understand, this P0 is adjusted for discount, premium or flotation cost. But in this case, there is no growth. Suppose my dividend is 8. Suppose my dividend is 8. So 8 divided by, suppose my price is 100 and my discount is 10 and my flotation cost is 10. So 8 divided by 100 minus 10 minus 10. So 8 divided by 80. My cost into 100. So 8 divided by 80 into 100, my cost will came down to 10%. That's why we calculate for zero growth model. On the contrary, so before we go for normal growth, it is called as dividend capitalization model, because we are using the dividend as a capital base. So dividend capitalization model. But if I take a growth in dividend, then I will use D upon KE minus G. That is price equivalent. But if I want to calculate KE, then KE would be equal to D upon P0 plus G. D upon P0 plus G. Again, this P0 is adjusted for discount, premium or flotation cost. That's why we calculate the normal growth. Suppose if I say my dividend is 4.75 and price is 100, which I received, and there is no discount, no premium, no flotation cost, but growth is of 6%. So my dividend 4.7. 5, price 100, growth 0.06, so 6%, whereby my cost of equity with growth came down to 10.8%. That's the second way by normal growth we can calculate. It's also called as dividend calculation or cost assessment using your growth rate. Similarly, here I'm assuming the growth rate is constant, but the growth rate can also change. So under the change growth rate, the growth rate will be variable, sometime high and sometime low. So we need to understand how we do assess under variable growth. Under variable growth, we need to assess the cost stepwise. So under stepwise approach, we need to calculate one by one each step. So let's see how do we calculate cost of capital if we using the variable growth. Under variable growth, first we have to see how much time period is for normal growth and how much time period is for supernormal growth, because without assessing the time period you cannot calculate your growth. But while assessing the growth rate, you need to understand how do we calculate growth. So growth rate is equals to your dividend into 1 plus rate into n, then it will equate to dn. Under this equation, D0 stands for first year dividend. First year dividend means how much you are giving. Then your 1 plus R indicating present value factor for nth year. Present value factor for nth year. Then we can multiply with n. So your growth rate would be equals to D0 into 1 plus R into n. but by this only we calculate the rate of growth. But if I want to calculate cost of equity under this model, then step 1, I calculate the present value of all dividends given, which are for stage 1 supernormal growth. So stage 1 is for supernormal growth. Under supernormal growth, how do we calculate dividend for number of years? So the time period for supernormal growth. So dt upon 1 plus ke raised to power t, where t may be for year 1, 2, 3. Suppose it is d1, then d1 will be equal to d0 into 1 plus g. d2 will be equal to d0 into 1 plus g square. So thereby we calculate dt. So dt will be d1, d2, d3, d4. So first I calculate the present value of dividend for the supernormal growth period. That's the way out. Suppose I am calculating for 5 years. So I will calculate from d1 to d5. That is d5 d0 into 1 plus g. So that is 5 raised to power 5. Thereby I calculate the supernormal growth present value. Now in step 2, what I do? Now step 2, I calculate the price of share. At the end of 5th year. Why 5th year? Because supernormal growth is for 5th year. Now while calculating price of 5th year, I will take dividend of beginning of 6th year, because 5th year is already ended, 6th year is started. So D6 upon cost of equity minus growth rate. Now here growth rate will be taken for normal growth. The normal growth which is calculated or given. Now price with normal growth. So my P5 will be equal to dividend of 6th year upon cost of equity minus growth rate. Suppose we got this value. Now once we got this value, so suppose this value came down to say 140. Now this 140 will be multiplied with 1 upon 1 plus cost of equity for 5th year, because we want the price present value today. So suppose we have 140, so 140 multiply with 1 upon 1 plus ke raised to power 5. So whereby I got my discounted value. So step 1, I got supernormal growth present value. Step 2, I calculate the price and its present value. So P5 is equal to D6 upon KE minus growth. Once I got value, I calculate its present value also. So price calculated into 1 upon 1 plus KE raised to power 5. Why 5? Because we are calculating price in the 5th year. Once I got this value, under step 3, I do what? Step 1 plus step 2. I got my actual price of the share. That's way we are trying to assess the equity share value. So step 1 plus step 2 will come down to step 3. Makes me aware about my price. If my price is same as the price given, then cost of equity is valid. If my price is coming to be high or low compared to the present price, then it is difficult to find out the equity in this case. Then I have to again take a cost of equity, again go for step 1, step 2 and step 3. So this is an assessment of cost of capital under variable growth rate. So that's way we have done 3 approaches of dividend capitalization. Number 1, zero growth. Number 2, constant growth or normal growth. Number 3 is your variable growth. Let's go for third approach is for equity, that is your earning capitalization. Now earning capitalization meaning thereby present value of expected future cash flows and net proceeds. How much you are going to pay and how much you have already received. So that comes under your capitalization approach, earning capitalization. So under earning capitalization, the formula will remain same, only your D will be replaced by E. So previously we done KE is equal to D upon market price. Now we do E upon market price, assuming that all earnings are distributed. So under earning capitalization model, we do E upon current market price. But we have assumption. Number one, we assume that there would be either 100% retention ratio or 100% dividend payout. Second, we assume that company satisfy the requirement through equity share and company doesn't employ any debt. So these are the two assumptions which we need to follow. Important part is that all these are the parts of dividend capitalization approach or earning capitalization. Now we can use one more approach called as bond yield plus risk premium. Now I say that company is paying 10% interest on debenture or bond, so 10% plus there is some risk premium because we are issuing debenture, so this will be there. So what I do, I add some premium for risk. So under bond yield plus risk premium approach, what I do, I take a base of debenture for assessing cost. So bond interest plus risk premium. Suppose bond yield or interest is 10%, premium for risk is 3%. So I would like to calculate my cost as 13%. That is my bond yield plus risk premium approach. Next, realized yield approach. Very, very important. This approach say that now we try to calculate cost based upon the dividend of the previous years. Now, dividend of the years, say from year 1 to year 5. Now, what I do calculate all these dividends. Now, on these dividends, I calculate their present value. So, present value of these dividends minus the cash inflow already received. So, present value of dividend minus present value of already money received as market price. If the value comes to be equal for both inflow and outflow, the cost of equity is calculated. So by assessing this present value of dividend, I assume my cost of equity say 10%. Based upon 10%, I calculate present value of dividend and present value of inflow. Inflow value remains same because 0 year factor is always 1. If both are equal, my rate will be 10%. If not equal, I will again re-go for the process by assuming any other rate for cost of equity. But under realized yield approach, we have few assumptions. Number one, firm's risk does not change. Number two, past yield is the base for shareholders' expectation. Number three, there is no opportunity cost. Number four, market price of the shares does not change. These four assumptions we need to follow while assessing cost of equity by realized yield approach. Let's go for cost of equity assessment by capital asset pricing model. This model we have already discussed in the previous units. Now, but again reiterating, while assessing cost of equity by CAPM model, we assume few assumptions. Number one, market is efficient or perfect. There are no taxes. There are no transaction costs. Securities are completely divisible. You can break them into n number of units. Investors always prefer minimum risk, maximum return. They have homogeneous expectation and you can buy and sell any investment, any security. There are no restrictions. We have all done these assumptions. So as per CAPM model, we use our equation that cost of equity is equal to risk-free rate plus market rate, that is your RM or KM. Market rate minus risk-free rate into beta. We have already discussed this. Suppose my risk-free rate given to me, then I calculate my market rate is already given. I calculate my extra money which I will receive. For example, if my risk-free rate is 7%, market is 13, but beta is 1.2. Beta 1.2 means that if market change 100%, I will change 120. Suppose my rate is 7 risk-free. So risk-free 7 plus. How much is market excess? 13 minus 6. So 13 minus 7, 6. 6% market is excess. So how much I would react? 6 into 1.2. So I will react excess. Excess how much? 7.2. Why? Because beta is 1.2. So my cost of equity will be 7 plus 7.2, 14.2. But this 7.2 is your market risk premium which you are getting because you are facing with the risk. So cost of equity can also be calculated by using your CAPM model. Now I know that we have done assessment for cost of equity, retained earning, debenture, preferential. Now we need to calculate WACC. Step already discussed. Number one, we find the source of fund, we calculate their cost, we calculate their weight, we multiply their cost with weight, then total weighted cost divided by weights. We calculate WACC. Now while assigning the weights, we can use book value weight or market value weight. Book value weight means that the value given in the balance sheet, that is the exact issued value for shares or debenture. If I take market value means that the value based upon the market price. Third, we can also use capital structure weight, meaning thereby the component issued at present. So how much debt we have, how much we have equity in the capital structure already given. So we can take book value weight, we can take market value weight, and we can take book value weight. So book value, market value, and then capital structure. Now while deciding cost of capital, we need to have certain factors. Some factors are controllable, some factors are uncontrollable. So factor affecting WACC. So controllable factor like capital structure. Can I know my capital structure? Yes. Once I know my capital structure, I can control it because I know how much debt I have to issue, how much equity I have to issue. Second, do I can control my dividend policy? Yes, because I know how much to retain and how much to distribute. So I can formulate my dividend policy which will affect, because if I retain more, I will have opportunity cost. If I distribute more, I need money to be arranged by equity or debt. Third, investment policy. If I retain money, I need to invest. Otherwise, it will incur me an opportunity cost with no return. So, controllable factors are capital structure policy, dividend policy, investment policy. Now, what is uncontrollable, which is beyond my control? Beyond my control is number one, tax rate. Tax rate is the rate which will affect actually my taxable income, because I have to pay tax on my taxable income, which will affect my overall cost of capital. Why? Because cost of debt includes assessment of tax. Similarly, can I control interest rate? No, because interest rates are changing by the RBI policy. Can I control it? Absolutely not. If market rate changes, bank rate changes, my interest rate will change. Third uncontrollable factor is your market risk. Can I control my market risk? No, which is systematic, because market keeps on changing by economic factors, social factors, political factors, and so many reasons. So I can't control my market risk. So we have uncontrollable factors like socio-political, like market, like tax rate, interest rate. So while deciding WACC, I need to assess how many are controllable factors and how many are uncontrollable factors, whereby I used to calculate my WACC. Next slide. I hope we have done book value assessment, that is your given weights, market value, your market price based weights. So that's way we calculate overall cost of capital. Now we also know, previously we have discussed flotation cost. Again reiterate, it is a cost in the form of legal fees, admin expenses, brokerage, underwriting commission. All is a part of your flotation cost, which is normally assessed on face value. We can also calculate percentage of flotation cost on issue price if required, but normally it is calculated on face value. So this unit clarifies me about cost of capital assessment for variety of sources.